Hello and welcome to my channel. I'm Robert, and today we are going to discuss an update to Range Hunter. I have recently added a mean reversion probability statistic to the Range Hunter module. Now this is a part of Jackrabbit TV, so be sure to visit the links below if you are interested in it. This probability determines the likelihood of whether or not price is going to return to the median. The median, of course, is this thick black line and is determined between the highest high and lowest low of a particular range. For the purposes of this chart, this range has been set to the daily time frame to be able to get the best information possible. The very bottom is the lowest low and the very top is the highest high. The goal of this statistic is to try to provide information that will give you a probability of how likely price will go back to the median. The median is often referred to as the fair market value or fair market price. This is where both buyers and sellers tend to agree on what the asset is actually worth. When prices are down here at the very bottom of the range, it is often considered undervalued, meaning you're going to get more people wanting to buy it because it is at a discount. When prices are at the top of the range, it is considered overvalued. It's too expensive and people are going to want to sell to take their profits. When people buy, the value is increased because the amount of liquidity of the asset decreases on the market. When people sell, the value decreases because there is more liquidity on the market for the asset. Now it should be made clear that this technique only applies to assets that are typically cyclical in nature. And that is an absolute critical point that must really be underscored. The assets must be of a cyclical nature. Assets that tend to go one way or the other on a constant basis. This technique will not work. Mean reversion goes on the theory that assets will always go back to the median. It will always go back to fair market value or fair market price. Not every asset does that. So you need to do your research, understand the market, and understand where the market sits in relation to its totality of price. For example, we can see on the daily chart that the probability is 91% that the market is going to go back to the median. The higher the probability, the more likely that is going to occur. Think of the distance between the median and the bottom as like a rubber band. The probability percentage is the pressure that you have stretched that rubber band. The higher that number, the more likely that rubber band is going to snap back to the median. And the more aggressively it could happen. Now the caveat to this, or the big warning that has to be made clear, is that isn't always true. Mean reversion is about probability of price movement. not about how long it may take before that happens. Just because the market has a 91% pressure to go into the long direction or price will climb doesn't mean that it can't sit here for a year or 2 years or more in a stagnant sideways track. Mean reversion just tells you what the probability is, not the likelihood of when that probability will take place. So you must always put that into your factoring when you're looking at the market. So let's go back to the 1 minute chart and then look at the possibilities of what this means in the long term. Right now, we can see that there's only a 36% probability of it returning to the median. That means very likely it could go back down, and that is roughly a 60% chance of it going back down. So you want to be able to focus your trades on the bottom portion. For example, 90% or 95% likelihood that the market will go back to the median. And this applies for both long and short. For example, if the price is down here on the bottom, then you want to open a long position. But if the price is up here, then you'll want to open a short position. Again, know your market. Not all markets are cyclical. So let's go through a few of the cryptocurrency markets and see how this really looks. For example, this particular market is only a 5% chance of returning to the median. Now remember, the median is the zero line in terms of this probability. So because the probability of mean reversion is above the zero line for its actual price, if you wanted to open a trade using a mean reversion technique, this would be a short trade. 5%, in my opinion, is not worth the risk. Evaluate your risks carefully. This could go either way, in my opinion, and not something I would personally open a trade in using a mean reversion technique. Let's go to another. Again, this one is kind of close to the median. In fact, just about at the median. So for mean reversion, this would be a complete hold. Stay away from it. Don't even deal with it. Let's keep going and see what else we can pick up. Now this particular asset is at an 81% chance for a long position. It could be a good opportunity to take in 1 or 2% take profit. So it would definitely be worth looking at if your risk assessment fit this type of a situation. Of course, looking at the different time frames, you would actually be able to determine better how that fits in. For example, let's go to the daily, if I can hit the right button. The daily time frame shows a 75% chance, but we can see from the history that it typically isn't that strong of an asset over the last couple of years. So even though this is at a good chance for a long position, we can clearly see that it's not going to be that much of a movement. So that type of a risk assessment can help us get into the market for a simple 1 or 2% take profit, maybe even a 5% if you're looking for a slightly longer hold time. Of course, you would want to put your stop loss at a lower level just in case, unless you're simply looking to hold no matter what. If you go to evaluate the Forex markets, though, or you're in a futures market, be sure you take into consideration the decay rate and liquidation factors. Personally, I would not recommend holding too long for a decaying market. Let's go back to the 1 minute. Always check higher time frames, though, to get an idea of what the historical advantage is going to be in relation to your trading. Here is another asset that has gone back and forth over its median quite aggressively in the short term. Let's take a look at the long term, though, and see where it sits. If I can manage to hit the right button. And we can see for the last couple of years, it has been at the low end of its value. So it really is at a dangerous point to where it may not be all that attractive to enter into a position. We can see that really the high point is right in this area for the last couple of years. So it might be simply worth not dealing with this asset in terms of a mean reversion technique. Always check higher time frames for your mean reversion. We can see, again, looking at where it's at, the probability is a basis of exactly what you think the range is going to be in terms of how it's going to affect your profitability. For the consideration of moving forward with this video, I'm going to keep it on the daily, just so we can see the better long-term outlook of the potential for whether or not an asset is going to move back towards the median. And we can see pretty clearly that even though this one does get close, it has a historical prevalence of being close to the bottom of its long-term range. So that really does make a difference in terms of your trading technique and style. So always look at the long-term range in relation to where the price probability is to the median. Let's keep going and let's look at Bitcoin. We have a 74% chance of returning to the mean. But the problem is most exchanges in the United States only allow long positions. And in fact, that's true of quite a few European countries as well. You'll want to be aware of that when you're dealing with this type of an asset. Bitcoin is a strange asset because it displays some cyclical tendencies, but not entirely. It is going to, I believe, go back towards the median, but again, timing is everything. And as you can see, how far it goes below the median is questionable. So you want to be aware of the depth you're looking at as you look at the history of the asset. This is one of those situations where you have to really trade carefully and look at perhaps smaller percentages in the short term versus more aggressive trading techniques that might want a 20% or 30% profit level. So you'll need to really carefully consider your options when trading Bitcoin. Now, if you're going for a short-term market, then you can see that the short-term market isn't all that good. It's only a 14% possible or probable chance of reversion. So that's not a good market either way. And if you get into some of the lesser coins that are more volatile, you can see that this does exhibit cyclic nature, but you need to be careful about how well it does. And you can see that both long and short, this is just not a good place to be. Now let's look at a very aggressive cyclic market. A market that is known to be very cyclic in nature. And we can see the euro British pound has an 88% chance of reversion. That is important because it is definitely cyclical. So the short term looks very good, and it just came off of hitting all-time highs. That is a higher probability of retracing down to a fair market value, which will be your median. So let's look at the daily. And we can see that the daily is only around 21%. So this one needs to be treated with care. The short term looks good as long as you have your expectations for just tiny amounts of profit. The long term clearly shows that it has a lot of wiggle room and could be better. And in fact, if we look at the very basis of what it's doing right now, it looks like it's about ready to go back up in value. So that could be some opportunities if you're looking to counter trade or divergent trading. But take that into your risk assessment, because it is absolutely critical that you really think about the ramifications of just what this asset can do. Let's see if we can find another interesting asset. Now we can see here that the long-term prospect has us hitting a new low and then the price reverting upward. So let's look at the short term. The long term is 36%. The short term is 80%. This could be a good opportunity for getting some good profits in. And we can see that it updated and it's now roughly 79% likely to continue its reversion. So the higher this number, the better. And that is incredibly important in trading. Always use probability and statistics on your side. They are not guaranteed, but they go a long ways to providing you with information to help you make a proper risk assessment of whether or not this instrument is stable to trade. So always think about that as you trade. If you like this video, please give it a thumbs up. Let me know what you think. Share your thoughts. Do you use mean reversion techniques in your trading? I'd like to know. And if you do, how do you decide when is a good time to get into the market? Thank you for watching, and until next time.